Investment Vehicles for Wealth Creation. Hello and welcome to this video edition. It's me again, your host Sophie, from Tony's team. I am so glad to be here again today. There is a lot of content about financial freedom on our channel. I hope you'll subscribe to have access to our other similar content. Our Facebook community also needs your likes. Please follow our Facebook page to get reminded about new updates happening on our channel. Investment vehicles are a way for an individual to invest their money in order to grow it. This means different things to different people. For some people, investment vehicles might mean trust, while to other people it might mean something else. When it comes to investment vehicles, there are several forms you can leverage. However, the larger majority of people prefer to use the ones that help them to invest and provide more security. Here is the analysis of some investment vehicles that might interest you. Number 1. Pension. When we say pension, what do we mean? We mean a form of investment in shares, bonds, and property that allows you to pay the minimum amount of money as your tax without going against the law. A pension is one of the programs that give you the benefit of tax relief, a reduction in the amount of money you'll pay as tax. Generally, people assume pensions to be the most reliable way of saving money for their retirement. However, it's just one of many options that you can leverage. Moreover, there are a number of irregularities with this form of investment, some of which are: restricted access. You're not allowed to have access to your money whenever you want to until you reach a certain age, usually 65. Capital forfeiting. You may have to forfeit your capital in exchange for regular income by purchasing an annuity with your money. Inconsistency in the policy. Yes, from time to time, policies surrounding pension changes, which makes understanding your position as an investor a challenge. This ambiguity can be very risky and also implies that there are chances that their charges are huge. Number 2. ISAs. This is another way to save your money from the taxman. With an ISA, you'll have the opportunity to hold different kinds of investments like funds, shares, bonds, etc., within it and save your rewards from getting taxed. However, you should understand that the value of your investment can rise and fall, and you may not get back what you invested. But you won't have to pay any income or capital gains tax on the return that you get from your investments and only keep it to yourself. Because of this tax efficiency, I'll recommend protecting your investments in ISAs. Number 3. Structured products. This is an investment that usually contains a bond together with one or more derivatives. They're primarily meant to provide an investment payoff that attracts investors by giving them the assurance of a limited risk, where they'll promise them the security of at least getting back their investment at the end of a fixed period, even if there's a downturn. The period of investment lasts for 5 to 7 years, and their value is based on a certain stock index such as FTSE 100. In recent times, the structured product has gained significant popularity. Although it appears attractive because it involves limited risk, the rule of thumb did not cease to apply, as the potential gain you can get from it is also limited when compared to higher risk investments. Number 4. With profits and endowment policies. With profits is an investment form where you'll be required to invest a regular amount consistently for a long period. Even though this appears to be nothing disadvantageous, this investment can put you at your wits' ends. How? If by possibility, you're not able to maintain the regular payment, the chances are that your return from the investment can be significantly decreased and you may have to face a huge penalty. This is why it has been strongly denounced by many people in recent times and has been largely rejected. Moreover, with profits are characterized by inflexibility and ambiguity in policy, which depicts that their charges can break the bank. To make things look fascinating, with profits and endowments award bonuses annually, but you cannot get the largest bonus till the end of the fixed period, which the majority of the people don't reach. It may look unworthy of mentioning this investment to you. However, I included it so that you do not only know what to invest in but also where not to invest. Number 5. Unit trusts, OEICS, ETFs, and investment trusts. Do you wonder what all these are? There's no need to worry. They are types of funds that pull investors' money together into a box of diversified investments, which can include stocks, bonds, and other securities. These funds provide investors with diversification by spreading the fund's money into different securities and helping to regulate investment risks. The funds listed above offer you the advantage of withdrawing your money at any time you want. This makes them a flexible option. If you ask for our recommendation, we will advise you to go for ETFs and investment trusts, as their charges are lower compared to OEICS and unit trusts. If you find this content valuable, please subscribe to our channel, like and share the content for others to benefit from it. Also, let us know your views and comments in the comment section below. To create these videos, take a lot of time and effort, so we need your love, comment, like, and share, and we will make sure to create even more interesting videos for you. Don't forget to check our website Lifestyle Tips by Antoaneta.com and grab one of our courses or books. Thank you again for watching. And remember, always stay very motivated.